Hello, class. Hello, professor. Our group was assigned commercial mortgage-backed securities. So we're each going to go over our individual findings for the project, and then we're going to come as a group together and determine the best credit rating agency for CMBS. So I was assigned Moody's and Kroll. So the key similarities revolve around the process of determining the credit rating. It begins with the real estate. So both Moody's and Kroll come up with the net cash flow that the real estate produces, and they give that real estate their value. Now they have the real estate, then they look at the loan that's secured by the real estate, and they look at two important characteristics: the debt to service coverage ratio, which tells how much money the borrower has to pay all of its existing debts, and the loan to value, which tells how much equity the borrower has in the property. Then what they do is these are two important indicators to the risk of default. So they say, okay, based on these two indicators, how much of a loss are we going to expect on these loans? Based on that loss, they come up with the credit enhancement. And then they look at all these loans from a macro perspective, and they look at the pool of loans, and they measure the diversity of the loans using a Herfindahl score. Based on that diversity, they adjust the credit enhancement levels as needed. Some key differences between Moody's and Kroll. The main difference is that Moody's benchmarks their credit enhancement at two anchor rating levels, whereas Kroll benchmarks their credit enhancement at four anchor rating levels. Furthermore, Moody's begins their credit enhancement at a later process, whereas Kroll's begins theirs at an earlier process. And Kroll's credit enhancement is framed around their stress net cash flows, whereas Moody's is framed around the debt service coverage ratio and the loan to value. Also, Moody's is more qualitative, whereas Kroll's is less qualitative. For example, in the structural and legal considerations part of Moody's methodology, they look at the loans and they want to make sure that the properties have property insurance, just in case any harm comes to the property, they're insured. Whereas Kroll's doesn't have that specific wording. They do talk about qualitative components that are considered, but they're not as in-depth as Moody's. And Moody's is less quantitative, whereas Kroll's is more quantitative. And that leads to my next slide. From the two different perspectives, as a portfolio owner looking to get my deal rated, I would choose Moody's over Kroll. The reason is because of the qualitative factor. And specifically, in Moody's methodologies, it states that based on the portfolio owner's track record of previous securitizations, based on that performance and how well it did, they could put my loans through less stress and less credit enhancement. However, it should be noted that if I don't have a track record and I'm new to the game, they will also take that into consideration, and they will put my loans through more stress and more credit enhancement. And as an investor, I would choose Kroll over Moody's because of the quantitative factor. So Kroll's gives me as an investor the opportunity to follow along in a detailed analysis of the cash flow, whereas Kroll's does not give me that opportunity. So with Kroll, I'm able to run my numbers and see how that projects to their defaults. And now Zbig is going to go over his findings for his project.
Okay, so I personally worked on DBRS Morningstar and Fitch Ratings. So both agencies tailored a report to multi-borrower CMBS deals within the United States and Canada. The general idea is the same for both reports. They standardize loan losses based on vital financial components and then create models that predict losses and defaults for entire loan groupings. Naturally, both reports mostly use the same metrics and lexicon to describe their findings. Some of those profound metrics are what we all read. So the LTV, the SCR, probability of default, loss amount, the loan amortization, and property type. Both firms run 500,000 Monte Carlo simulations once all their metrics are organized and put into their databases. They use the outputs to adjust loans negatively or positively, depending on what criteria is safer or riskier than expected. So let's elaborate further and then differentiate these two. So let's start with Fitch. Fitch goes by analyzing their loans on the property level, then providing a base case expected loss on the loan level, and finally aggregating data on the pool level. Each loan gets a probability of default, a probability of loss, and a loss amount. These three metrics are what constitute expected loss. Expected losses are then aggregated and applied to entire loan pools. Default and loss projections come from many variables. Some of them are factual, such as property type or location, and others are simply judgment-based, such as net cash flow, property quality, Fitch constants, and cap rates. Next, the company assesses collateral attributes. Fitch does collateral analysis by taking a sample of the 20 largest loans, or about 60% of the pool. The company then performs site visits on some of these samples, and they rank them from A to D, where A portrays the best property quality. The agency also assesses their assets based on their relative risk. It does this using a volatility score of 1 to 5, where 1 is deemed as the most stable. Like other factors, there are other factors, but these are some of those crucial ones. And like mentioned before, Fitch runs simulations on US and Canadian loan pools based on 500,000 scenarios of default and loss over a 10-year period. Fitch models those losses, and then they provide adjustments accordingly. Next, so diving into Morningstar, DBRS took a slightly less technical approach to its methodology than Fitch Ratings, and DBRS primarily focused on collateral analysis, the quality of mortgage servicers and counterparties, as well as CMBS transaction structure and legal documentation. More precisely, they also sample the top 10 to 15 loans to assess the ratings. They will run and this balances out to about 50 to 75% of a conduit pool balance. The company seeks to find base case loan loss estimates based on the study samples. They analyze the samples thanks to standardized metrics, again like the NCF, the sponsor strength score, and property quality designation. Individual loan factors will aggregate into pool level losses and ratings. Each metric is made up of more granular parts, which Morningstar gathers. The company checks current rents, historic rents, appraisals, and engineering reports. So that's how the firm gets stabilized net cash flow. Next, Morningstar will pool 40 to 80 loans. They will analyze 25 to 35 of them. And from those samples, they will get an average net cash flow, which they'll apply to every loan thereafter. So DBRS then analyzes the people that are involved in the transaction. This means, again, the servicers, originators, operating advisors, and other parties. Each parties are contractually written out. Morningstar makes sure to check each lender's warranties individually. The firm assumes that mortgage title policies are in order unless they're disclosed. They do not, however, review insurance policies, but expect lenders to have practices set in place. So finally, from my end, let's look at some potential decision making. So if I had a portfolio of loans that I would want to securitize, then I would personally choose DBRS Morningstar, and that's because DBRS has a more relaxed rating policy. And if I were a seller of CMBS loans, this is what I would look for because I could get a higher profit from the transaction. The company with less strict policies will give me a higher rating. A higher rated securitization will be more expensive, providing me with a greater return. In addition to this, a less strict agency won't require as much paperwork and fees for certain criteria. And an example of this would be insurance coverage. Fitch demands insurance coverage for each property that covers even terrorist acts, which will clearly be more expensive than a less encompassing insurance policy. So again, in short, DBRS will allow me to get a higher sales price, less fees, and in a quicker time frame. Now, if I was an investor, then I would choose Fitch Ratings. That's because this is the opposite of the first scenario. So obviously, I found Fitch to possess a stricter rating policy. As an investor looking to buy CMBS bonds, I want accuracy and reliability in bond ratings. If a company's criteria is harsher than its competitors, then it will likely mean that it's more accurate. So therefore, I just have a greater certainty of my purchase. And again, one example of this would be that Fitch checks environmental status, and they even expect phase 1 environmental site assessments to be conducted by contractors of national recognition for each property. The agency really went deep down into small details such as this, and that shows their assiduousness on their part. So thanks to more precise ratings, I'll have a more predictable and safer cash flow, which will earn me the best return in the long run as an investor.
Hello, Professor and everyone. This is Hanbi, and I'm going to compare Moody's and DBRS Morningstar. Moody's and DBRS Morningstar seems to follow a similar pattern since they both talk about CMBS. Both methodologies combine essential commercial real estate analysis with structured finance analysis for the transactions secured by a pool of commercial real estate assets in the United States and Canada. Let's look a little bit more closely. Moody's methodology describes its approach to rating conduit and fusion CMBS, while DBRS Morningstar focuses on conduit transactions. Moody's conduit transactions are collateralized by a single property or by a group of properties of average quality, and Moody's fusion transactions combine a conduit pool with a small number of loans with low leverage. On the other hand, Morningstar's conduit transactions are based on the pool of multiple commercial mortgage loans of varying sizes from multiple borrowers. Moreover, they focus on slightly different key elements of their analysis. Moody's has the 5 components, such as property, loan, portfolio, net cash flow, and legal and structural constellations. Moody's has 2 tools to analyze the property: red, yellow, green, which is the short-term supply and demand balance diagnostic tool; commercial mortgage metrics, which is a forward-looking assessment of credit risk. Once Moody's has concluded their property-level analysis, Moody's analyzes the loan characteristics to identify the term and refinance default risk and the loss. For conduit transactions, Moody's sets up the debt service coverage ratio and loan-to-value to benchmark levels. For fusion transactions, Moody's assigns the probability of default and the recovery rates in 2 different ways, depending on whether the fusion loan has low leverage or high leverage. Like Jacob mentioned earlier, for tracing the country version of credit enhancements, Moody's uses the AA2 and B2 credit enhancement levels. For fusion deals, Moody's has 3 steps. First, quantifying the key credit metrics of the fusion loan. Second, assigning loan probability of default and recovery rate. Third, using loan probability of default and recovery rate and pool diversity. Once Moody's completes its asset analysis, they analyze the loan pool's liability structure to make current payments on CMBS certificates. Lastly, Moody's combines the quantitative analysis with its assessments of qualitative factors, including the operational and counterparty risks, idiosyncratic structural features such as advancing rated final maturity date, servicing property insurance, representations and warranties, and bankruptcy remoteness, and transactions legal risks. In case of Morningstar, it consists of 3 components: fundamental analysis of selected CRE assets, evaluation of the quality of the mortgage servicers and any other key transaction counterparties, and lastly, a review of CMBS transaction structure and key transaction legal documents. As you guys see this slide, Morningstar has the shorter analysis steps. For the first step, DBRS Morningstar conducts one-star reviews as well as loan file reviews, such as proper historical financials, budgets, and the most recent rent rolls, larger tenant lease terms, summary of the critical term from the mortgage legal documents and opinions, and third-party reports. Especially DBRS Morningstar uses the CMBS Insight model, which generates expected loan level best case loss estimates. And other two steps are similar with Moody's, but way simpler. As a borrower and an investor, I would choose Moody's. Credit ratings are opinions about risk. Whose opinion do you trust the most? Moody's is one of the big three credit rating agencies, which the markets actually use its ratings in day-to-day securities pricing decisions. Moody's provides advanced information that capital market participants have relied on its ratings in the buying and selling of securities for nearly a century, which was founded in 1909. According to the information on Yahoo Finance, Moody's has higher growth in the earnings per share, market capital, and current dividend yields than DBRS Morningstar. In addition, Moody's ISS Governance Quality Score is 2, while Morningstar's score is 5. The score of 1 indicates lower governance risk, while a 10 indicates higher governance risk. One more thing, Moody's profit and operating margin is also higher than DBRS Morningstar.
So S&P focuses on standalone, large loan, and conduit fusion transactions, while Kroll focuses on diverse conduit fusion, and CRE CLO securitizations. Both methodologies apply to the initial ratings and ongoing monitoring, and in the case of significant credit changes, full analyses would be triggered by both agencies. Now, with regards to the data, there are some shared sources like CoStar, whereby they both utilize historical loan performance to recalculate cash flow projections from those of the issuer. And other sources of data are more nuanced, like rent and cap rate adjustment factors based on CBRE Econometric Advisors data as used by S&P, and property type segments as outlined in CRE Finance Council's investor reporting package and used by Kroll. In both methodologies, primary drivers of credit enhancement levels are the loan characteristics themselves and their diversity. So essentially, what is the quality of the loans? For instance, the lease terms, coupon, and reserves, and how do we account for risk in terms of differences in things like property type, geographic concentration, and tenant quality? The Herfindahl Index in particular measures effective loan count and assessing pool diversity. It's also worth noting that Kroll goes more in depth with the calculations by leveraging regression analysis via loan sampling and extrapolation while taking into account anomalies. So for instance, loans with limited seasoning or a disproportionate loan size. There are also scenarios where assumptions are allowed. So for instance, with S&P, there are those around market norms depending on the asset quality. Now, moving on to the next slide, we see that both agencies then factor the qualitative components into their quantitative analyses in the use of their own cap rates, NCF, LTV, and DSC levels. So S&P LTV and SK LTV, for instance. And here, S and SK LTV means scenario adjusted, meaning that Kroll deliberately uses 4 tranches as so-called anchor rating environments in order to create stress scenarios that vary in regard to severity, timing, and duration. And as stated previously, sometimes assumptions can be made depending on subordinate debt and the pool at large. So with Kroll, such assumptions are factored into workout expenses when determining the gross and net liquidation values in cases of defaults. Overall, while both agencies more or less weigh the same factors, things like interest rate risk, special servicer risk, and aptitude and sponsor equity, and with great conservation, like with the required base credit enhancement levels, from just a visual perspective, how the methodologies read, Kroll really emphasizes the use of tables and graphs, specifically their term and maturity default curves. And the accuracy of these regression curves is reinforced with data from the CMBS default and loss study.
Hi, Professor. My name is Griffin Gallagher, and I will be comparing S&P and Fitch. Now, from just a basic summary level, they both focus on conduit and fusion loans in USA and Canada. S&P also focuses on standalone but Standard & Poor's rating agency may differ a little bit from Fitch, but the fundamentals are pretty much remain the same, and they're very similar. I mean, some of the basic principles they follow are just the credit quality of the assets, the cash flow, the payment structure of any given property or pool of properties, and they even go as far as to look at the operational and some administrative risks, even as far as to look at like the legal documents more for Fitch, because they focus a lot on qualitative measures. But for quantitative measures, both agencies remain similar. A lot of their measures and their ratios are pretty much identical from the property analysis level all the way up into the transactional analysis. And they also both account for near-term volatility, which gives more sustainable net cash flows and cap rates for a more long-term outlook on any standalone or pool of loans. For S&P, they rely on quantitative measures far more than qualitative. S&P, they have their cash flow analysis of every single property, so they take all the revenues and expenses, and then S&P will derive their S&P net cash flow. That net cash flow will they'll have minor adjustments to lessen the effects of near-term volatility, like I mentioned, but it's designed so they have a long-term sustainable flow of the given property. They also take the capitalization rates and divide them by the net cash flow of the property, and then that's when they derive the S&P value. And once the S&P value is derived, that's when they get to LTV and the DSC ratios. And once they have those LTVs and DSC ratios, they take those, and those are what really determines their transactions credit enhancement as well as credit risk, and their main methodology for rating any particular standalone or any particular pool of loans is to use the S&P LTV and S&P DSC ratios. Similarly, they do rely on some qualitative measures, some geographic concentration of the area, tenant quality, structural, and like I said, some legal features, but they don't calculate in terms of credit enhancement as much as the quantitative measures do, because that's their bread and butter. But like S&P, then there's Fitch, and for Fitch follows many of the same principles. They do the same property level analysis, loan level analysis, and transactional level analysis. A lot of the same ratios. They take the net cash flow, and they're able to use that net cash flow and turn it into their leverage, their value, and their loan defaults as expressed. Some of Fitch's main methodologies for sourcing their leverage is the Fitch DSCR and Fitch LTV. And again, those are just ratios that are taken into account near-term volatility and assessed to be long-term and have those sustainable long-term numbers for any particular property or pool. Some of the key analytical methods in deriving leverage is the DSC and LTV. Fitch also relies heavily on cap rates, and their cap rates are from historical data, which is often outsourced from third-party findings. When they use these historical data points with their current and forecasted data points, you often get fairly accurate cap rates that reveal long-term sustainable data. But unlike S&P, Fitch relies heavily on their qualitative measures like durability of income, which is even more of a macro level idea, and Fitch will review a transaction and all the corresponding documents until pretty much all measures have been exhausted, and even after a close analyzation, Fitch may deem a transactional document insufficient or even below industry standards, which will lead them to not even rate the given transaction. So that is Fitch and S&P in a small nutshell. But Thank you very much, and I will pass it off to Esther.
Hello, Professor. Hello, team. My name is Esther, and I was assigned to compare Morningstar DBRS and Kroll Bond Rating Agency. And I am sure my teammates have been sharing the opinions that we all agreed together, but to, give a little more of a subjective analysis between the two. I found, although Morningstar DBRS, as my teammates may have mentioned, although it has very quite an organized report of how they do their analysis with 3 divided core collateral analysis, it seemed to me that the report was a little bit more elementary, and they assumed investor discretion, and they were very lenient on accepting originators' data and their evaluations instead of conducting their own rating evaluations on many aspects and components. Whereas Kroll, they certainly have a more extensive and detailed rating models, and they want to show that to the investors. And the report clearly states how they use those values and numbers, and what inputs go into each models. And the most important thing being the KBRA value. They explain well in how the value is determined with the in-place rents, market rents and vacancies, their operating expenses and capital expenditures, and how those are plugged into the models in order to generate the 3 credit functions, and what they're interested in are the rental rate and occupancy scenarios, probability of default, and loss given default estimate. And those definitely showed more qualitative and quantitative evaluation of their portfolios. Especially the biggest difference I saw is that Kroll does not assume a single case scenario. So for their stress case scenarios, they use 4 different levels. And even for their pool concentration adjustment tests, they use 4 levels of Herfindahl tests to make sure that they're sorting out the less diversified loan pools so that they can accurately rate them with the ones that may have higher risk concentration. And most importantly, Kroll conducts ongoing monitoring and surveillance of the environments and the economy. So as an investor, I said that I definitely trust Kroll more, and that would be the rating agency of my choice, because I think their interest aligns more with the investors. Whereas as an originator, I would choose DBRS for their leniency and the higher likelihood of them giving a better and higher rating for my portfolios. So those were my findings.
So as a group, we came together and we shared our findings in the individual assignment, and we compared and contrasted the credit rating agencies. And we agreed that Moody's and S&P were the best credit rating agencies for CMBS deals. Our methodology into deciding Moody's and S&P actually began with a process of elimination. So right off the bat, we thought DBRS was extremely vague. And just to bring it into perspective, DBRS's methodology was only 30 pages, whereas the other credit rating agencies were 40 to 50 pages. And it may not seem like a big deal, but in those pages, the other credit rating agencies have the ability to go more in depth with their methodologies. So we crossed them off right off the bat. Fitch, we thought the cash flow analysis was a very important part of this methodology process. And Fitch did not do as good of a job as the other methodologies did. They attached it as an appendix in the back, and even then, they didn't even really go into depth on the breakdown of the cash flows. And then Kroll, on the other hand, was relatively good with their cash flow analysis. However, compared to Moody's and S&P, they're new to the game. They were only formed in 2010. So risk-averse investors would probably shy away from Kroll because of their experience, and Moody's and S&P's track record is far superior to Kroll's. And so those are some of the reasons why we eliminated DBRS, Fitch, and Kroll.
So our group has decided on the split between Moody's and S&P. The reason for not going for a unilateral decision is that we deemed both to be rather equivalently ranked for the needs of portfolio sellers and investors. So what was our logic in this? Well, to start, the agencies are old and they're time-tested. Moody's dates back to 1909 and S&P goes back to 1941. So clearly the two have experience in their work. And despite being old companies, they're certainly not decrepit, as they're still the two biggest firms in the security ratings market, with about 40% market share each. Another aspect that we looked at was that they are both public companies. This may seem like a minor fact, but it shows that the firms are open with their information. Aside from the evident prestige, they also had the qualitative and quantitative standards that we wanted to see. S&P, for example, had a great use of cap rates. It used a property's historical cap rate data, and then it blended it with current info as well as with future forecasts. And then Moody's, on the other hand, mentioned a Herfindahl score, which measures a property's competition. So this is just one unique aspect that our group liked, as there are a bunch of others. And we think that portfolio sellers and investors could go either way of these companies. It simply depends on each person's situation. To end, we would like to state that it's important to utilize and appreciate rating companies as they promulgate financial information. Still, nonetheless, when dealing with financial transactions, it's key to use one's own due diligence and to use common sense. So that's it. Thanks for listening, everyone. And we'll take any questions that you guys may have now.